Hey everyone, and welcome back to the Finance Zone. Investing in stocks is an excellent way to grow wealth. For long-term investors, stocks are a good investment even during periods of market volatility. A stock market downturn simply means that the many stocks are on sale. One of the best ways for beginners to get started investing in the stock market is to put money in an online investment account, which can then be used to buy shares of stock or stock mutual funds. With many online brokers, you can start investing for the price of a single share. Today, we're going to be talking about how to invest for beginners. Make sure you stay as you do not want to miss out on this valuable information. Also, remember to subscribe and click on the notification bell. Number 9. Risk and return. Being a smart investor means having a good grasp on your risk tolerance. Certain financial products, such as stocks, are riskier than others, such as bonds. That's because there's no guarantee of profit when you buy stock. If a company performs poorly or falls out of favor with investors, its stock can drop, and you can lose money. Other investments, such as government bonds and certificates of deposit, are considered safe because they're often federally insured. However, returns from these investments are much lower as compared with stocks. Thus, a key principle of investing is striking the right balance between risk and reward. A balanced, diversified portfolio should include a mix of both low-risk and higher-risk investments. Number 8. Timing is everything. Patience is key for new investors. Long-term investments are more likely to yield higher gains. That's because your investments need time to grow. They also need time to adjust for the ups and downs of the market. On any day, stocks can plunge. Sometimes the economy takes a downturn for months or years. If you sell stocks when the market dips, you stand to lose a substantial part of your investment. Over time, investors who adopt a set-it-and-forget-it mindset are more likely to come out ahead of those who give in to the fear caused by market fluctuation. Number 7. Invest in what you know and understand. Buffett cautions you should never invest in businesses that you don't fully understand. He says that if before he invests in the stock of a company, he has to first understand how the company makes money and the main drivers that impact the industry in no more than 10 minutes. If he's not able to understand it in 10 minutes, he moves on to evaluate another company on this basis. Did you hear about Warren Buffett buying weed stocks? Right. Warren Buffett is known for investing in simple businesses. He invests in what he understands. Cryptocurrencies and weed stocks would fall short of a lot of Buffett's criteria. But the main point here is that he does not invest in something he doesn't understand. If you want to invest like the man himself, you shouldn't either. Understanding something about the industries or companies you invest in will make it easier to stay current on industry trends and company news. An investing strategy based on hype or following other people's stock tips is a recipe for long-term failure. If you're interested in a company you do not know but hear a lot about, research it first. Most people can't predict the next fashion trend among teenagers or whether or not a medicine will be successful in the market. Even if you had more data than anyone else, it's still impossible to predict the future with 100% accuracy. In situations that rely on an accurate forecast of the future, Buffett advises not to invest. If it's complex for you, just look for other businesses to invest in. Buffett once said that out of about 10,000 publicly traded firms, he would like to invest in only a few hundred companies, before even taking valuation into account. Number 6. Investing in bonds. When you buy a bond, you're really lending money to the bond issuer in exchange for an interest income and eventual repayment of your principal, the initial amount you invested. That income makes bonds productive assets. Within the world of bonds, you have several choices. U.S. Treasury bonds are considered to be safe from credit or default risk because investors assume the federal government will not fail to meet its obligation to pay you back. You might also consider investing in tax-free municipal bonds, which are issued by city and town, county, and state governments. These bonds are exempt from federal income tax and may also be exempt from state and local taxes. Finally, you can invest in corporate bonds, whose credit risk depends on the perceived creditworthiness of the company that issued them. Corporate bonds that are considered to be especially vulnerable to credit or default risk are called high-yield or junk bonds. In addition to credit or default risk, the other major type of risk bonds is interest rate risk. A bond's yield is its return based on the interest or coupon rate it pays to holders and its price in the market. In the bond market, yield and price move in opposite directions. When yield goes up, prices go down, and so does the bond market. And when prices in the market go up, yields go down. That's because when prevailing interest rates go up, not specifically the rate for that particular bond you're holding, newly issued bonds will generally offer a higher coupon rate to keep up with the overall trend in rates. The bond you're holding will be less valuable in the market because there are now other bonds offering higher rates, and so its price will go down as yields go up. Number 5. Investing is a long-term game. Once you have a list of stocks whose metrics look attractive, narrow it down by choosing businesses that will hold up well during recessions. This is why Buffett loves to invest in utilities. Eliminate businesses that are highly dependent on a strong economy, such as retailers that sell discretionary or luxury products. Money doesn't grow overnight. By getting 9 women pregnant, you can't make a child in a month. No matter how good the talent or attempts are, Warren Buffett is just saying some things take time. Investment planning should be done by considering the long-term goals. Investor goes for futures and options with the hope of making quick money, but they are actually the one who loses more money. Stocks are a long-term investment. The movement of the share price in the short term is unpredictable. Trying to bet on what will happen to a stock in the short term is near impossible. There are several things that can give a business an advantage, such as efficiency, scale, or a proprietary technology. To give one example, Buffett's favorite Coca-Cola has an amazing distribution network, as well as an extremely valuable brand name that gives it pricing power. Number 4. Risk and return. Being a smart investor means having a good grasp on your risk tolerance. Certain financial products, such as stocks, are riskier than others, such as bonds. That's because there's no guarantee of profit when you buy a stock. If a company performs poorly or falls out of favor with investors, its stock can drop and you can lose money. Other investments, such as government bonds and certificates of deposit, are considered safe because they are often federally insured. However, returns from these investments are much lower as compared with stocks. Thus, a key principle of investing is striking the right balance between risk and reward. A balanced, diversified portfolio should include a mix of both low-risk and higher-risk investments. Number 3. Be aggressive during tough times. It's generally a bad idea to time the market. Long-term investors will probably do fine no matter when they buy. Yet, it's still important to look for opportunities during tough economic times. I often tell people that one of the secrets of successful long-term investors is that they love market corrections as they offer the best opportunities. Some individuals are not supposed to own stocks at all because they are too annoyed by price changes. If you're going to do stupid things because your inventory is going down, you shouldn't own stock at all, Warren Buffett said during a CNBC interview. Some people aren't really mentally or psychologically fit for their own stock, but I believe more of them would be, Buffett said, if they were more informed about what they're actually purchasing, which is composed of a company. Number 2. Sell at the right time. When a company no longer matches your reasons for buying, sell the stock. If you determine it needs to be above its 2-year average stock price and it falls beneath it, then you sell. This is what most Buffett followers miss. He has rules and he diligently follows them. When a company no longer fits his criteria, he sells. Resist the urge to make excuses to stay in the investment. Sell it. Period. Number 1. Trust yourself to become a successful investor. Warren Buffett says the hardest thing is to trust your investment decisions. You always think that others are right and you are wrong. Instead, you need to study and believe in yourself. I always knew I was going to be rich. I don't think I doubted it for a minute. Warren Buffett. In one of his most famous quotes, he says, "We've long felt that the only value of stock forecasters is to make fortune tellers look good." Essentially, what he's getting at there is that what these analysts say about markets and companies should be taken as seriously as a fortune from a fortune teller. So you don't see Warren Buffett buying and selling stocks based on these market forecasters. He conducts his own research and sticks to his strategy. To be successful, you need to overcome the fear and not pay attention to what others are telling you. Accumulate understanding and create investment choices to stand apart from the crowd and be a winner on your own. To be successful, you need to overcome the fear and not pay attention to what others are telling you. Accumulate knowledge and make investment decisions on your own to stand separate from the crowd and be a winner. You can take these investment tips and apply them to your own investing, whether you're a new investor or an experienced investor. Thanks for watching. While you're here, go ahead and click one of these 2 videos on your screen. And don't forget to like, subscribe, and comment below. See you there, and thanks for watching.